Assalamu alaikum friends. So question number 6. As you can see here we have this is a group company. We have been given the statement of financial position for 2001 and 2002, 30th November. Okay, and it's a public limited company relating to Jocatt. We have been given the statement of profit and other comprehensive income, and we have been given the statement of changes in equity. Okay, statement of changes in equity. Sometimes it is given, sometimes it is not given, but most of the time statement of financial position and statement of profit and loss and other comprehensive income, this two statement is most of the time it is given. Okay, statement of changes in equity, it is not every time, but yes, it might be given. So when it is given, you have to make use of it, and you have been given some additional information. As you can see, there are a number of points. Now let us go to the requirement. Okay, because first we have to start by reading the requirements and then going to the case study. So part A, discuss with calculations. So the word discuss with calculation tells you what you have to discuss, also you have to calculate also. How goodwill arising the accusation of the T grade should have been calculated. So it is about goodwill, calculation of goodwill. Show the adjustments which need to be made to the consolidated financial statements. Even the adjustments you have to show. First 7 marks. Coming to the second part, in accordance with IS 7, prepare cash flows from operating activities using indirect method and from financing activity. Okay. Ignore deferred taxation other than where it is mentioned in the question. First 17 marks. We'll see the marking scheme later on, how the 17 marks are distributed. Okay. Then we have direct and indirect methods for 6 marks. Okay. The directors of Jocatt have commented that the indirect method of reporting cash flow from operating is more useful and informative user financial than direct. So this is the extent to which the directors' comment is valid. Basically, you have to compare. You have to tell about the pros and the cons of the direct versus the indirect versus the direct. Okay. I have done IS 7. I've completed IS 7. My video is there. You can go and check for IS 7. Okay, which has been divided into 3 parts. There are 3 parts to IS 7, but the part 1 is important for this. You only need to go through part 1, because in part 1 I have explained all the concepts and all relating to IS 7, and I have also told you why direct or indirect, which why the advantages and disadvantages of both the methods I've explained. Okay, and it's for 6 marks. So that means 6 points you have to give. Now let us go to the case study. So since all those you don't have to read, okay, we have to read the following information related to the financial statements of this one. First point is, okay, it's big enough, but we'll read it. On 1st of December 2001, acquired 8% of the ordinary shares of Target for 4 million and regarded as a financial asset at the cost of the purchase. Okay, when is the date? It is 1st of December. Acquired 8%. Okay, so this is not a subsidiary, neither an associate, because associate is from 20 to 50%. More than 50% is a subsidiary. Less than 20, it is counted as financial asset. Okay, and for 4 million, this is dealt. If it is less than 20%, please make sure that you know which standard deals with it. Financial asset, so it is dealt under IFRS 9. Okay, if you're not, if you want, you can annotate also which standard will be linked with it. Okay, next to it only you can write IFRS 9. Okay, so the first point is about IFRS 9. And it is regarded as financial asset at the cost of purchase. The investment was measured fair value through profit and loss. Okay, you have to know investment was measured at what, whether it is through other components of income or through profit or loss. It is through profit or loss. Next, on 30th June 2002, okay, 6 months from that 1st of December 2001, not even 1 year, 6 months, acquired a further 52%. Okay, so this is a step accusation. First it 8, then it's 52. So 8 plus 52 makes 60%. Okay, further 52% of ordinary share of take rate and gain control of the company. The purchase consideration transferred on 30th June compromise cash and shares. Okay, so the consideration is cash of 15 million and shares of 15 million. And the fair value of the NCI was currently determined to be 20 million. So NCI, fair value of NCI is 20 million. And the fair value of the identified net assets at acquisition date, excluding the deferred tax, was 45 million. Okay. So the fair value of net assets excluding deferred tax was 45 million and included trade payables and trade receivable. Next, Jocatt has calculated and accounted for goodwill arising on the accusation of 5 million. Okay, so this was the goodwill they have calculated. You have to see whether it's correct or not. However, the following has not been taken into account. So definitely this is not correct because they haven't taken the following into account. What are the two following things? 30th June 2002, the fair value of 8% holding had risen to value of the 8% holding had risen to 5 million. In the consolidated statement of financial position, the investment is still classified as financial asset and is measured at 4 million. You see, it is still classified as financial asset and measured at 4 million. Can you do it? Because on 30th June 2002, what happened? You acquired a further 52%. So can you hold that 8% still on 30th June 2002? No, you cannot. You cannot. You have to add that 52 with 8% and then it will be a subsidiary of 60%. So you cannot hold it. So it's wrong. Second, tax base of the identifiable net assets of take rate was 35 million at 30th June 2002. Okay, the tax base of net assets was, and the tax rate is, see, because the moment deferred tax comes, they will give you the tax base and also the tax rate. Okay, now coming to part 2, the point 2. Goodwill related to all subsidiaries have been impairment tested in the year to 30th November 2002. Okay, and any impairment correctly calculated and accounted for. Okay, so it is correctly, okay, impairment, it is correctly done. Third, Jocatt operates a defined benefit scheme. So this question is a very good question because this question includes so many standards in one. It has an IS 19 which is talking about pension. It has deferred tax which is IS 12 which is the next standard I'm going to talk about. Okay, very recently I've just finished IS 10, so IS 12 is the next one. Sorry, IS 10 I'm going to discuss. After that we have IS 12 which is income tax and deferred tax is also there. Then this has your other standards also we have, we'll see. IFRS 9 is there, right? So many standards are there in this one question. Okay, so in SBR this is how you are going to be tested. Many standard, use of many standard in one question or in one requirement. Okay, so he operates a defined benefit scheme and the service cost component of the year ended 30th November 2002 is 16 million. Okay, so the service component is 16 million and the net interest component is included within the finance cost. Is included within the finance cost. Fourth, use of the fair value model for measuring investment property. Okay. No investment properties have been purchased or sold in the current period. Jocatt sold property with a carrying amount 10 million for cash of 18. Depreciation for the period was, so depreciation was 27 million. He sold PPP. Carrying amount was 10 million and cash for 19 million. So he made a profit. Okay. Next. Okay, so that's all. Now let us go to the answer. So before going to the answer, goodwill, calculation of goodwill comes first, right? So what are you supposed to do? Let us read the tutorial now. Reconcile the movement and the carrying amount of goodwill between the two reporting dates to calculate the impairment. This should be added back in the reconciliation between profit before tax and cash generated from operations. Okay, time being, leave it. When we go and you'll understand it. So goodwill. So opening balance and the closing balance. Okay. What is the opening balance? And then we have acquired. Okay. So this is working, okay, for goodwill. I'm sorry. This was the working. Okay, so acquisition of target is here. Okay, the calculation comes in the working because you need to discuss and you need to calculate. So calculation comes in the working, and you are discussing. This is your answer. Calculation of accusation of trigger rate. So what's happening in the case study? You need to say, okay, Jocatt obtained control over trigger in stages. You see, in stages he obtained control, also known as a step accusation. He immediately didn't have the control. He first acquired 8%. That time he didn't have the control. Later when he acquired 52%, then he got 60% together. So then he acquired control. Okay, it was in stages. That's why it is known as step accusation, step by step. Not together, they didn't purchase the 60%. First 8 and then 52. So on 30th June 2002, Jocatt should have revalued the previous 8% to its fair value 5 million. So basically, you are explaining your calculation. Okay, what are you doing in the calculation? Or you explaining in writing. You should have the skill of writing in words. What are you calculating? If you are not, then you are not going to pass SBR, because SBR major, I think 95% is that only explaining your calculations. So they should have revalued. Okay, they should have revalued the previous 8% investment to its fair value 5 million. The day when you have acquired the remaining 52%, what do? That day, what is the fair value of that previous 8% investment? So they have given you the fair value to 5 million. It should have been revalued at that day, but which they didn't. Okay, so you need to write it, and in the fair value 5 million and it in the goodwill calculation. Revalue the previous 8% investment to its fair value 5 million and it in the goodwill calculation. Okay, because it will affect the goodwill calculation. So this adjustment will increase goodwill by 5 million, right? It will increase the goodwill by 5 million. You need to tell when an adjustment increases or decreases goodwill. In sentences, you have to write. How do you know this will increase the goodwill by 5%? Because what is it? It is the value of an investment, right? And it is there. It will come in the goodwill. It will increase the goodwill. It will be added. So a gain of 1 million. How 1 million? Because it was 4 million. It was valued at 4 million. But now it is 5 million. So the difference. So gain of 1 million should have been recorded in the consolidated. Where does gain go? They go in the statement of profit or loss. They should have been recorded in the consolidated statement of profit or loss. So the adjusting entry is, what is the adjusting entry? Since goodwill will increase, it's an asset, so debit it by 5 million. Financial asset needs to be credited because now it's no more financial asset when you have acquired on 30th June. Remember the date, on this date. Okay, if you're not, please go through the requirements again and see which date they have asked you. Yes, they told goodwill arising on the accusation of this one. So definitely goodwill arise when you have acquired it, the remaining 52%. Okay, not the first 8%. So that's why uh, initially it was a financial asset debited. Now it needs to be credit. You need to remove it out. It's no more a financial asset. So that's why credit the financial asset 4 million. And then what was the gain? The profit. It is 1 million. So credit. Always check your debit and credit. Okay, it needs to balance. If it does not, then your calculation somewhere some figure went wrong. But it needs to balance. So if you see debit side is 5 million, credit side 1 plus 4 is 5. Okay, so 5 and 5 is correct. Next, the identifiable net assets. Okay, so you're talking about the identifiable net assets of Tigrid at acquisition are consolidated at their fair value of 45 million. Okay, so this creates a taxable temporary difference of 10 million. Okay, creates what? Taxable temporary differences of 10 million because the carrying amount of the net assets in the consolidated financial statement exceeds the tax base of 35 million. How? Because the tax base in the case study was given as 35 million. Okay, we know that a taxable temporary difference arises when the net asset minus the tax base. So 45 minus 35 is 10. Okay, and your net asset value is more than tax base. That's why it's a taxable temporary difference. Okay, 10 million because the carrying amount of the net is in the consolidated financial management exists the tax base and a deferred tax. So tax was how much? 30%. 30% on taxable temporary difference. So deferred tax liability arises for 3 million. Okay. How 3 million? 10 million into 30% in the consolidated statement of financial position it will go. Liability, no? Liability goes there only, deferred tax liability. This is treated as the part of the subsidiary's accusation net assets. This deferred tax liability is treated as what? Subsidiary's accusation net assets. It comes in the net assets of subsidiary, okay? When you have acquired the subsidiary, you acquired this also. And therefore, the goodwill at the acquisition will also increase by, so even the goodwill will increase by 3%. Because if your net asset increases, remember the formula for goodwill. If you're not understanding the direct impact on goodwill, how this will increase, how this will decrease, then remember how you calculate goodwill. It is net assets, right? Sorry, it is consideration plus the fair value of NCI minus the fair value of net assets. Okay, So because of this, when your deferred goodwill increases, it's a liability. It's something that needs to be deducted. So your net assets goes down. If your net asset goes down, okay, remember when you're calculating goodwill, net assets are deducted. So when you're deducting a smaller amount, definitely the goodwill will increase, no? When you minus something by 5 or versus when you minus something by 2, definitely something which you have minus by 5 will be, the number will be more smaller, no? But something if I have minus by 2 by a small amount, the number will be bigger. So like this, you have to understand goodwill. Okay. Net asset, if it reduces, goodwill will increase. This is the relationship. Higher the net increase, sorry, higher the net assets, lower the goodwill. Lower the net assets, higher the goodwill. So because of deferred tax, net asset will reduce. That's why goodwill will increase. That's an opposite relationship with goodwill. Okay. So that's why it will increase by 3 million. Now, so since goodwill will increase, again debit goodwill, deferred tax liability is a credit, so credit 3 million. Okay, 3 and 3. Now how goodwill is calculated? So this is the formula. So fair value of consideration, you start with fair value of consideration, right? 15 million of shares and 15 million of cash, both you add 30. Then we have fair value of previous equity interest. Okay, previous equity interest, that 8% interest, the fair value that also has to be included, which is now 5, not 4. Okay, then we have fair value of NCI, already they have given 20. Then we deduct the fair value of net assets excluding the deferred tax, okay, at acquisition, which is 45. Okay, and because deferred tax is shown separately, okay, they have shown the deferred tax separately, that's why they didn't include it here, it needs to be added. Okay, so deferred tax, deferred tax is 3, and finally goodwill on acquisition is 13, because you told credit deferred tax liability. Okay, so it needs to be added here. Just wait, just a small thing, I want to see the deferred tax part. There was a note relating to it where they told that ignore deferred taxation other than where it is mentioned in the question. Okay, okay, so their net assets at acquisition excluding the deferred tax was 45 million. Okay, so you are showing it 3, then it is this, so 13 is your goodwill on acquisition. Next, right? So now let us go to the second requirement is the extracts. You have to make statement of cash flow using the direct and indirect method. Okay, operating and financing activities. So starting with operating activities, this is the indirect method. Okay, always you have to write the heading, please don't forget the heading. You have to write it's an extract from Jocatt to statement of cash flow for the year ended which year. Okay, then you make 2 columns. This is a pro forma of cash flow. Okay, please go and check my video on IS7 where I talked about pro forma of cash flow. You start with operating activities. What is the first item you start with? Profit before tax. Okay, what is the profit before tax? If you see, it is 44 plus 1 million gain on take rate. Okay, so 44. Okay. You need this is the profit before tax, this figure. Okay, this 44 you need to tag, and with this you need to add 1 million. Why 1 million? Previously you have had a gain, right? This 1 million they are talking about, because you have revalued the previous 8% holding. So that gain also will be added here. So that 1 million gain on take rate needs to be added and 45 million. Then we have the finance cost. You need to add. Finance cost was how much? It is 8. Finance cost is 8. So you add it. Then come to depreciation. Depreciation 27. You add. Okay, it is there in the other notes. Then we have gain on take rate. So you added here in the profit before tax. Now you deduct it. Deduct the gain back again. Even though you might be saying that what is then you might be saying that why to add and deduct, because it's the same, right? There will be no effect on it. You are adding in one place, deducting one place, so it's the effect is nil, but you have to show it like that. When you are getting marks for showing it like this, you have to first add in the profit before tax and then you need to deduct that gain. Okay, now coming to the retirement benefit service cost, it is 16. How it is 16? Retirement benefits scheme. You have to go to the other notes and see. Okay, so point number 3, the service cost is 13. Sorry, 16. So that service cost 16 comes in the profit and loss account as an expense. So now you need to add it back, 16. Now coming to the gain on investment property and impairment on goodwill. So gain you will deduct, impairment you will add, profit on sale of land. Okay, so in land you have the carrying amount was 10 and you have sold it for 19, so the difference is 9 and you have to deduct it. Okay, now coming to the two items. Okay, one is impairment of goodwill, which will be added, and gain on investment property. First we'll calculate the impairment of goodwill in the working one. So here opening balance. Okay, what is the opening balance? Here, this is the opening balance. This is the closing balance. 40 is the closing balance. Okay, 68 and 40. And another piece of advice, this is a hint for you. For those students who does not understand that the 8% was a financial asset, you have been given in the balance sheet the financial asset. So this shows you that definitely you have to deal something relating to financial asset. Okay. So now, sorry, coming to the working. So opening balance is 68, closing is 40. But here if you see the closing becomes 48. With that 40 you have to add 8 million of something. We'll see it later. Now accusation of take rate. So with that opening balance you have to add when you have acquired take rate from part A. If you see this was the goodwill. You see this goodwill, this 13 you have to add it with the opening balance of accusation. So you are adding that 13 and then the impairment is the balancing figure. So before getting the impairment we have to get to the closing figure. What is the closing figure? 40 plus 8. That 8 is also from first part, right? A first part. How did you get 8? Because here you have debited goodwill 5, here you have debited goodwill 3. So 5 plus 3, 8. Okay, this is on 30th June 2002, the closing year. Okay, so therefore goodwill is 8. It needs to be, and that add is added with this 40. Okay, 30th November 2002, the closing balance is 48. So now once you have this 2 and the closing balance, the balance is the impairment. Okay, 33. So this 33 needs to be added there. And now coming to the investment property, the gain needs to be deducted. What is the gain? But fair value gain and loss of investment properties are recorded in statement of profit or loss, right? Even though they have told that it's other comprehensive income, but it is in the statement of profit or loss. Okay, fair value gain relating to investment property. So opening and the closing, opening and closing you will get from your balance sheet. Okay, when you need the opening and closing figure, look at your statement of financial position. So go to the investment property. It is 6 and it is 8. 6 is the opening, 8 is the closing. Okay. See, if you see, it is 6 and then 8. So what is the gain? The balance between these two is 2. It's a gain, right? That's why the closing increased from the opening. That's why the gain is 2. So this 2 already, if you see here, which has been deducted, it's a gain. Okay. So finally, now coming to this part. Cash paid to retirement benefit scheme working for. Okay. What is the cash paid? Since it's a cash paid, so it's a deduction. It's in bracket. Bracket matters a lot. Okay. The number which are going to be deducted should be in bracket. Outflow, cash outflow. Cash paid to retirement benefit scheme working for. So now let us go to working for. Okay, working 3 is taxation, but we'll go it later. First we'll go to working for. Defined benefit scheme. Okay. So the movement of the defined benefit scheme during the year compromises service cost component. What are the things the service cost is there, the net interest is there, and the remeasurement component is there. Remember that the remeasurement component is taken to other comprehensive income, and it is therefore not an item. It is not an item. Should be adjusted with. It cannot. You cannot take it in PNL. It is only in other comprehensive income only. Therefore, it should not be adjusted. It should be adjusted for. It should not. It is not an item that should be adjusted for within the operating activity. The cash contribution paid in the plan are present in operating activity. Okay. Yes. So the cash contribution is paid. Okay. Now what is it? Opening and the closing. How do you get the opening and the closing? Opening is here 22, closing is here 25. Defined benefit, pension deficit. Not under your non-current liabilities. You have the balances 22 and 25. With this, you have to take note. You have to take note 3. Note 3 you have to take. Service cost was 16, interest is 2. Okay. So your service cost component will be added. Net interest 2 will be added. Closing we already know. Contribution paid is the balancing figure. Okay. This needs to be deducted. But before that before this contribution, we have to find out what is the net remeasurement component gain for the year per OCI. It is 8. Okay, per OCI means we have taken from OCI. Okay, see how we are taking the figure from different places. You have to be very quick at this. This wastes a lot of time picking information. Okay, it is 8. Net measurement gain, this one, this 8. The net remeasurement gain on defined pension benefit. This we are getting from the profit and loss account. Okay, this 8. So this add needs to be deducted. Then we are getting the contribution 7. So this contribution 7 only we have to take here and deduct it from here. Where is it? Go to the okay, the 7. The contribution is paid. Next we are working with the receivables, inventories and payables. So here we take how much it has increased or decreased from the statement of financial position, but in two places we are doing further adjustments. One is trade receivable, we are deducting -5. Sorry. And the other area is trade payable. We are deducting 6. Okay, all are inflows. Nice, that's good. So if you see here, inventory from 128 to 105, it reduced. So it's an inflow. Trade receivable, it has reduced, inflow. That means customers are paying now. And trade payables are increasing. That means you are taking more time to pay your supplier. You are holding their cash, so cash inflow. Okay, now we have two more adjustments relating to trade payables and receivables. So receivables, these are in your subsidiaries, this thing. Okay, subsidiaries account. So when you're taking subsidiaries account, so when you're acquiring the subsidiary, you have to pay cash to, okay, so that's why these two are deducted. Receivables of 5 and 6 payables. Whenever it's an acquisition, the subsidiaries assets or liabilities are deducted. Okay, because it's a cash outflow. Not that one will increase, no, both will be reduced when it's an accusation and when it's a subsidiary's assets or liability. So trade receivable is also deducted by -5, trade payables also -6. This is clearly explained in IS 7. Okay, both in the first and the second part of IS 7 video. So once all are inflow, then we have the term. Please write the term. Terms is very important. Okay, the term is known as cash generated from operation 272. With this, you have to deduct three things. Sorry, two things. One is income tax, one is the interest paid. So income tax paid, working 3 is there. Separate working is there for the tax. Okay. Then for interest paid also 8 minus 2. Why? Because here if you go up and see how much finance cost you added 8. So with that 8, 2 million interest we have on defined benefit plan. That needs to be deducted because they told it was already included in the finance cost. That 2 million of defined benefit plan interest was included in the finance cost. We are taking that 2 out. 8 minus 2, 6. Okay. And now we'll see how we got 18 as income tax paid. We'll go to working number 3. So taxation, let us read the note. We consider the opening and the closing balance for both income tax and deferred tax in a single working. Please understand it. In a single working. Okay. For both income tax and whenever there are two, one is income tax, one is deferred tax. In your statement of financial position, together add both and make it in a single table. Okay, single working, not separate. Remember to include any charge for the year, including profit and loss and also in other comprehensive income. Yes, if you have any charge, whether it's in profit or loss or whether OCI, it should be taken there. You should also ensure that you correctly deal with any tax related balances on a subsidiary acquired or disposed of during the year. When it's relating to the subsidiary acquired or disposed, you need to be very cautious of it. Okay. Now let us see taxation. Okay. So opening tax and closing tax. If you see the opening is 41 plus 30. Okay, we have to go to the statement of financial position. You will get it from the statement of financial position only. If you see here, there are two deferred tax 41 opening balance, and then we have the current tax payable 30. So opening you will be adding 41 plus 30, and closing you will be adding 32 with 33. Okay, 32 with 33. This is how you are taking as a single working. Okay. So here also you are taking like that. 41 plus 30, the opening balance, and the closing balance also 32. You are adding with 33 plus another thing, this 3. How this 3 million came in the closing balance of the deferred tax? Because we have a deferred tax of 3 million. Remember, credit deferred tax liability. That will be added in the closing balance, that 3 million. So 68. Now we have deferred tax on accusation. So on accusation, when you have, what is it? From parts, first part, we have done it. When we have acquired, this is the deferred tax. The 3 will be added now. Then what was the charge for P&L and charge for year in OCI? There are two. One goes for P&L, the other one is for OCI. Let us see. You have to go to profit and loss account. Okay. So profit and loss account, if you see, this 11 is the income tax, and where's the deferred tax? Tax on the above, this 1 million. Okay. Under OCI. So both that 11 and 1 you have to take. Okay, so that 11 and 1, and whatever is the balance is tax paid. Okay, 18. So this will be deducted from cash generated from operations. Generated from operations. Okay, so this 18 we are deducting it. Next we have 248. This is from operating activity. Now let us go to the cash flow from financing activity. Will be same under both direct and indirect method. The only difference which is there between direct and indirect method is in the operating activity. How you calculate the operating activity, the starting. Rest investing and financing activities is same under both the method. Okay. Now coming to the financing activity. Why not investing activity? Why don't you make investing activity also? Even if you make, you will not get any marks because the question didn't ask you so. The question only asked for operating and financing, so stick to that. Next. Just wait a minute. I want to go to the statement of financial position. Okay. So even if you make the whole, just see there is no bank balance, cash or cash equivalent is not there. So you will not know whether your closing amount is correct or not. So there is no use of making a full-fledged cash flow statement. They didn't ask. Okay, they just asked for extract. So it from now let us go to the financing activity. So financing activity, we have three things. All our outflows. What is it? Repayment of long-term borrowing. So we have repaid the long-term borrowing. Then NCI dividend. First statement of changes in equity. Statement of changes in equity. Okay. SOCIE means statement of changes in equity. Okay. It stands for statement of changes in equity. Please know it. Know this thing. Don't write short form in your exam. Okay. So NCI dividend. Because you have to pay dividend to NCI, deducted. Dividends paid by Jocatt. So this also will be deducted because you have to pay. So ultimately it's an outflow 20. Now let us see long-term borrowing. To see the long-term borrowing, you have to go to the statement of financial position and see from 71 to 67 you are paying off. That's why it went down. Next, about the dividends. How are you going to get the dividends? You have to go to the statement of changes in equity. If you see here, it is how much? NCI is 11. 11 is going to the NCI. And 5 is retained earnings. That means this is going to the owners only. Definitely something dividend, if you are paying for the retained earnings, it goes to whom? The owners only. Okay, so the 11 is for NCI. Clearly they have told. So 5 and 11 as a dividend. Okay, outflow. Now, so after this it's over. Rest all our workings. Okay, working 1, 2, and it should be in order, proper order. 1, 2, with clear labels. If you see, every working has a label. Investment property. Working 1 is goodwill. Like this. Don't write sentences. 1 or 2 word is enough. Taxation. Then we have defined benefit scheme. Okay, each one is dealt using different standards. For example, defined benefit scheme is using IS 19, taxation is using IS 12, and then we have investment properties using IS 40, and goodwill is recorded using the business combination IFRS 3. Okay, so 4 different standards. Now coming to part B. Part B asked you about the indirect and the direct method. For 6 marks, you need to tell the advantages. Okay, so you have the freedom of writing this in your own way, but we'll go through the answer to get some points. Okay, and we have the marking scheme also. So the direct method, what does the direct method do? Wait, just let me go to the requirement because I misunderstood the requirements, I think. Okay, so using indirect method, cash flow from operating or financing. They didn't say to use direct. Okay, I got confused that we have to prepare using both methods. Only for the explanation we have to use direct and indirect. Okay. So now let us go to the second part. And see the answer. They are writing in different paragraphs. Okay, they are not writing together everything. So first paragraph says the direct method. What does they do? They present separate categories of cash inflows and outflows, whereas indirect is a reconciliation. So direct method separate the categories of inflows and outflows. Okay, but indirect method is reconciliation of profit before tax, reported in the statement of profit and loss to the cash flow from operations. It's like a reconciliation, the indirect method. So adjustments include, okay, there are some adjustments which are not there in direct, but they are there in direct method. What are they? They include non-cash items, for example, depreciation or impairment. Okay, in the statement of profit or loss, plus operating cash flow that were not included in the. So operating cash flow that were not included in the P&L, you have to add those also. Add or deduct. Okay. Second, a problem for user. Okay, so this is the problem for the user. Is that the fact that entities can choose the method used, this limits comparability. Because you have the freedom to choose either this or that, both are accepted under IFRS. Okay, limits comparability, number 1. Okay, so don't just write in bullet points. If you see the sentences, they always write, even though it's one sentence, They always write it one full sentence. They don't write in bullet points. So please avoid using bullet points. You have to write it in a full proper sentence. Okay. Next, 1 point, one paragraph. Another point, second paragraph. Third point, third paragraph. Like that you have to start. So number one, limit comparability. Okay. Second, see in the first paragraph they gave you the difference. Okay. That one separates the categories of inflows and outflows. The other one, indirect, reconciliation of profit before tax with cash flow from operations. Okay, and the adjustments. Second paragraph starts with the issue, the disadvantages. So number one is comparability. Second, majority of the companies uses indirect method for the preparation of statements of cash flow. Most companies justify this on the grounds that direct method is too costly. So they are saying direct method is too costly because most companies go for indirect method. From your textbook holder, this is from your textbook. The answer is right. Even when you go through my IS, this is what IS 7. You will understand the same line. But definitely I will not tell you to memorize, so you can understand and write in your own words. Okay, the direct method is too costly. Second, so that is the second. First, one, two, now the third. Users often prefer the direct method because it reports. So users prefer. See, companies preferring indirect method. Okay, companies use indirect method, but users prefer direct method because it reports operating cash flow in understandable categories such as cash collected from customers, cash paid to supplier, cash paid to employees, and cash paid for the operating expenses. In the direct method, that's what we do: cash paid minus cash received minus cash paid. Okay, so when presented in this way, users can assess the major trends in cash flows and can compare this in the entities. Yes, when you're presenting it, the cash flows in this way, you can see the trend also, where the cash is going. Are you receiving more cash from customer, or you have to pay more cash to the supplier? You can also compare this with the competitors also, the ones who are using the direct method. Okay, so one advantage of direct method is that. Okay, so see the before paragraph, you told direct method is too costly, but right after that you are saying it is these are the advantages. Okay, you have to give both advantages and disadvantages. Okay, because it reports operating sorry, why it is preferred. So the point itself is in the first line only. Okay, the rest all is explanation on that first point. They are explaining in detail. Okay, next, the last paragraph. Complicated adjustments required by the indirect are difficult to understand. So there are some complicated adjustments which are okay of indirect. They are difficult to understand. This again they are giving a disadvantage of indirect method and can be confusing to users also. So you cannot, for example, if you have to write this answer, you cannot just write that indirect method is costly, this is cheap, that is cheap. One line you cannot give each line and say that I'm writing in different paragraphs. No, you need to build up on that point. If it's expensive, why it is expensive? If it is easily understood, why it is easily understood? You have to give reasons. And giving reasons maybe 2-3 lines. That's it. So in many cases, these adjustments cannot be reconciled to observe changes in manner. Yes, you sometimes always you cannot reconcile the adjustments to what the observed changes in the statement of financial position. Okay, so here they are giving a demo also how it can be difficult to be understood. That adjustments cannot be reconciled. So with that, we have finished question number 6. Now let us go through the marking scheme in detail to see how you are getting the marks, because the first question, how much it was for 17 marks. We'll see how the 17 marks has been divided. Okay, part B, 1 mark per point. Okay, for 6 marks means you can give 6 points. That means one advantage, one disadvantage of each. So you can give 3. You can divide and give. Okay, it's not equal the 3 advantages or 3 disadvantages. No, sometimes you might have 2 advantages or 1 advantage versus 4 disadvantage. So like that also you can give, but you have to give for both direct and indirect method. Okay, now come to the marking scheme. Part A. Okay, part A, how you are getting the 17 marks. So first part, accusation, is 1 mark per point. Okay, that's how you are getting the 7 marks. Next, cash flow statement. How are you getting the remaining marks? So profit before tax, 1 mark. You start with it. For adding finance costs, adjustments, these are adjustments. Okay, finance costs, you get another 1 mark. That is your okay interest. Then retirement benefits expense, the service cost, another 1 mark. Depreciation to add another 1 mark. Revaluation of gain on investment property, another 1 mark. Profit on the sale of land, another 1 mark. Impairment of goodwill, another 1 mark. Gain on take rate, another 1 mark. Trade receivable decreased, 1 mark. Inventory decreased, 1 mark. Payables increased, another mark. Cash paid to contribution, okay, that is your. We calculated it doing workings. Finance cost paid, 1 mark. Income tax paid, 2 marks because working is required. A T table is required. Places where workings are required will be given 2 marks versus where places where directly you can pick up from the question, just 1 mark. Then we have repayment of long-term borrowings, 1 mark because it comes in your financing activity. NCI dividend, another 1 mark. And dividend paid, another 1 mark to the parent company. You see, that means you have to get all the places correct. Most of the places you have to get correct to score at least 50-60% of the marks given to you for a question. Even though you're not able to do full justice or get full 17 out of 17, at least you should be able to, your plan should be to get around 10, 11, 12 out of 17 like that. Okay. So with this, I have successfully completed question number 6. See you in the next question with more doubts and some more beautiful, some more things to learn. Till then, take care.